you have income or assets that you've kept in the shadows from the IRS, we'll talk about how you come out of the dark on this episode of Taking Shelter. I'm your host, Peter Paulson. To help me talk about that situation, I welcome in Eli Naw. Eli is the head of tax controversy resolution at Frost Tax Law. Welcome back to the show, Eli.
Thanks for having me, Peter. I appreciate it.
Doing this initial analysis, working with people to understand their alternatives, what kind of underreporting can be subject to IRS action?
So there's a few different components to underreporting. Failure to report income, failure to report assets, and failure to report potentially interests in foreign business entities, or think about foreign gifts and inheritance. That's another hot area, a significant area of enforcement right now with the government. So when you think about those few areas, amongst others, there are other areas, but those trigger requirements such as FBAR, foreign bank account reporting, the FinCEN Form 114, to report foreign bank accounts that exceed $10,000 in the aggregate. You have your analog, which is the Form 8938, what people here call the FATCA report. And then we talked about the inheritance on Form 3520, and there's also Form 5471 to report interest in foreign entities, foreign businesses, among other forms, Peter. It's hard to go through all of them, as you know.
You have to be willing to be very open and transparent with the attorney you're working with who's trying to help you through this process. So, for example, I had a client in Vietnam who was married to a Vietnamese spouse, and they were going to the U.S. His assignment was over, and he came to me and he said that his wife's uncle, wanted to give them a wedding present of $100,000 because they'd been married recently, and he wanted to know how to get that back to the U.S. because he was conscious of the bank account reporting of over $10,000 transfers. And I quickly realized this was not a gift from the uncle, that this was income that he had not reported during his foreign assignment, and therefore it created an asset that he had not reported during his foreign assignment. And it completely changed the dynamics of that conversation. So when you go through this process, when you start this process, you have to be willing to put all your cards on the table and help the people who are trying to help you. Where do you start worrying about criminal prosecution, and how do you go from the big C to the little c as part of this process?
When you're looking at willful versus non-willful in the civil arena, the government has a much broader definition of willfulness, that they can encapsule somebody who has non-compliance and potentially subjects them to those really significant penalties. But on the criminal side, you're really looking at acts of evasion, overt acts, intent, and certain elements such as that to determine whether or not there exists true criminal exposure. When coming into compliance, you really want to determine whether there's civil exposure or criminal exposure. We'll start with criminal first. If you have criminal exposure, you're going to look to the Voluntary Disclosure Program. That program, you come headfirst, CI, requesting clean hands, and when you utilize that procedure, you're going to come to compliance for 6 years, FBARs, and 6 years worth of tax returns. The FBARs will be subject to a 50% FBAR penalty, the computation of which is somewhat involved, and you should consult with a professional before just doing the back of the envelope. And on the income tax side, there is going to be the taxes that are due for 6 years, but the year with the highest balance due will be subject to a 75% fraud penalty. So for someone who has a significant amount of unreported income, that is a significant calculus as well, but a small price to pay to stay out of prison.
Well, Eli, I can see people listening to this that might be thinking, wow, that is a lot of penalty exposure. Maybe I'll try one of these other 4 ways, and if that doesn't work out, then I'll go ahead and try the voluntary path that you talk about with the big penalties. Is that a good strategy, bad strategy?
So if you have criminal risk, that is a bad strategy. They're going to be looking for people who have criminal exposure that are trying to utilize or abuse some of the other programs and essentially make examples out of those people. And in order to really flesh out that conversation, Peter, I think it's important to talk about what people who don't have criminal exposure what options they have to come into compliance. The real big one that people want to know more about, because it's all over the internet, is the streamlined procedures. And that really breaks down into two different types. There's the streamlined domestic and the streamlined foreign. The streamlined procedure can only be used if you are not willful, and you must certify that under penalties of perjury. Somebody who has criminal risk is going to have a very difficult time certifying that they were not willful utilizing the streamlined procedure. The streamlined procedure is essentially a way for taxpayers with non-willful non-compliance to come into compliance. And the basic tenets of the program are, there's the domestic program and the foreign program. The domestic program and the foreign program both require 3 years of tax return corrections and 6 years of FBAR filings. The big difference between the domestic and the foreign is the streamlined domestic comes with a 5% penalty, and the streamlined foreign carries a 0 penalty.
They can play hardball, and particularly if you are trying to knock that square peg in the round hole from the start. What is the IRS's typical initial reaction to these alternative programs?
So when submitting a voluntary disclosure, everyone already knows the elephant, right, is in the room, is that this is a criminal case. And the IRS is aware of that when you're coming in, because otherwise, why would you be utilizing that particular procedure? The streamlined procedure and the voluntary disclosure are really used when the voluntary disclosure being criminal risk, the streamlined non-willful, but both of them have an element of unreported income. When there is no unreported income and it's simply inheritance or a foreign gift that just requires informational reporting, or some other transaction that or ownership that requires informational reporting but doesn't necessarily come associated with any income tax non-compliance, then you may consider using what's called the delinquent submission procedures. There's delinquent information return submission procedures, which is designed for any informational reports such as the FATCA 8938, 3520, 5471, and so on, informational reports other than FBARs. And then there's the delinquent submission procedures for FBARs, late FBAR filings. That procedure says, or used to say, that if you had reasonable cause, you would submit a reasonable cause statement, and the government would not automatically penalize you with these late information reports. And you should consult with a professional as to how many years back you should go before doing this. But essentially, this procedure is one where if you had reasonable cause and came into compliance, you weren't supposed to be penalized. We've been seeing that that's not what's been happening. The IRS systems are routinely issuing penalty notices to people utilizing this procedure, and have really changed the dynamic of it, and have really taken the wind out of the sails of people wanting to come into compliance utilizing this, because the systems are automatically penalizing and essentially disregarding the reasonable cause statements. So in an uproar from tax professionals, I think the IRS ultimately made some changes to their website and acknowledged that, look, from now on, when you submit these delinquent submission procedures, we may or may not read your reasonable cause, and you may receive a penalty that you have to respond to. And I think that does a disservice to both the IRS and taxpayers, because it really deflates the voluntary nature of compliance, or it really removes the incentive for people to come into compliance voluntarily, because they are being subject to this penalty and then having to hire somebody to go through the appeals process to try to mitigate or remediate those penalties or to abate them. And I think that's really a difficult situation for taxpayers to be in. So when considering a delinquent submission procedure, whether for an FBAR or other informational report, you should consult with a tax professional over the practicalities of what may happen and what that's going to look like, and be prepared for it.
Yeah, and we should distinguish too that there are some kinds of notices that taxpayers might receive, with maybe imposing a penalty, or you didn't do this or you didn't do that. In some cases, those are valid. You have to react to them. It doesn't necessarily take these formal procedures we've been talking about. In other cases, and have been recently published cases, the IRS computers get a little haywire. They haven't opened mail in a long time. The computers take over and assess penalties. And so all of those, by the time that, we talked about every different way you can respond to a penalty, this could be a very long video, right, Eli?
Right, exactly. And to really conclude in the other procedures or ways people come into compliance, I mean, there's always the clients that ask, what are my options? And, when I go through the procedures, the formal ones, they say, what if I do nothing? And I say, well, that's an option, but certainly not one that I promote. I think that people should be coming into compliance and sleeping better at night and coming out of the dark. And there's also what's called the quiet disclosures, which we get questions about a lot. And what a quiet disclosure is essentially someone who should be utilizing either a voluntary disclosure or a streamlined disclosure to come into compliance decides not to do any of those and amends tax returns to report additional income and also informational reporting, late informational reports with the tax return. And when they do that, they're trying to avoid either the heavy 50% voluntary disclosure penalty, the FBAR penalty, and the 75% fraud penalty. They're also maybe trying to get around the streamlined submission penalty of 5% and trying to see if they can skate with no penalties at all. When the IRS gets these cases and there are late informational reports, they assert all penalties, and it's an uphill battle to try to get them to come down. So when you're faced with the option of a voluntary disclosure from the criminal risk standpoint, there's also a civil penalty benefit to it, because while you get your clean bill of health on the criminal side, which is really the critical part of why you do a voluntary disclosure, there's also the benefits of getting the 50% FBAR penalty in lieu of all the other informational reporting penalties that you may be penalized as well. And in some circumstances, that savings can be significant on the civil side by using the voluntary disclosure. On the streamlined, you have a 5% penalty. I can tell you that the 5% penalty utilizing the streamline is almost always less than the penalty that's asserted by the government if you get caught or if you get audited and they assert penalties on a quiet disclosure.
So the process seems to be do your inventory, do the math, focus on the proper path to go down, willful, non-willful, criminal, civil. There is a lot of that goes into these remediations. So Eli, let's take a couple of examples. Let's take one of Anna. Anna moved to the U.S. from a foreign country. She's filed tax returns for many years and reported her U.S. investment activity, but she did not think she had to report the activity from assets that she had kept back in the old country. And to date, she's got no contact from the IRS, so it's kind of a clean slate from that regard. She wants to get right. What's the best path for her to move forward?
It's a great question, and the question really tees up an important point, is that not everybody who has non-compliance, does so intentionally, right? You've got people who immigrate to the United States and people who have family abroad, so I think that really highlights it. So the answer to this question really hinges on what we discussed a little bit earlier in the program, but it depends on the income and the willfulness. So let's assume that this particular taxpayer is not willful in that she innocently believed that she didn't have to report any of this, and there is income here. If there is unreported income, then you would look towards the streamlined procedure if she's not willful, and that would have what we discussed as the 5% penalty and coming into compliance for 3 years of amended returns. And that's typically a small price to pay in lieu of all the other penalties that could be out there. If there's no income, then you would consider potentially utilizing the delinquent submission procedures we talked about earlier.
Well, Eli, here's another question. What if I get into a program like that and work out a resolution with the IRS involving a payment of tax and penalties, but all my wealth is tied up in illiquid real estate development in Colombia? Is the IRS going to make me fire sale that asset to make good on what I owe them?
A lot of times with those programs, you typically have taxpayers that can pay because there are funds offshore, but in your particular example, it's illiquid in real estate. And, I think that's going to depend on how illiquid it is and how long it takes you to get that asset liquid. If you need 10 years, the government's not going to play ball with that, because typically they like to wrap up the payment in the disclosure process. So they typically assign a revenue officer associated with the case, and they're in charge of determining how quickly this money can be collected and what's considered a reasonable period of time. If it can be paid within a reasonable period of time, the government will allow it. The shorter, the better. but it's not something where they're going to allow taxpayers to hold on to something for lengthy periods of time and drip payment to them slowly.
What is the absolute first thing that somebody can do if they have these concerns about trying to come out of the dark of tax avoidance?
Really coming to a professional who has experience in this particular area of practice so that they can weigh the facts and circumstances unique to their situation and to mitigate both civil and criminal risk.
Thank you, Eli. That was very informative. If you have found this video helpful, go ahead and hit the like button. If you'd like to discuss your personal situation, your concerns, please contact the firm. This has been Taking Shelter. I'm your host, Peter Paulson.